Welcome to the video on my discussion on what I deem as what's called bounces and retracements. Retracement is something that we've discussed quite a bit in some of these videos, and a bounce, as it suggests, is something bouncing from a particular point. And once you begin to understand what bounces and retracements are, you will understand that that they kind of really much are your bread and butter in the trading that you do. You can, of course, obviously trade the trends, and you would always look to predominantly trade the predominant trend. But using bounces and retracements, in other words, points within relatively large ranges where we're hitting a resistance or hitting a support, allow us to make some good money from relatively short periods. So let's first of all discuss what a bounce is. Well, a bounce is usually a point where it's hit support, much like we see here. Let me put a line in, and we're seeing it bounce up. And a bounce usually happens from a very strong dramatic fall. So think of it much like we were discussing in terms of the momentum indicator, where you see you instead of dropping a ball, we're throwing a ball at the floor, and that force, as soon as it hits that floor, in this case the support, it bounces up. And if that force is quite strong, in this case it is, and we see it bounce up, the bounce tends to be relatively aggressive too, and as we can see, that bounce is aggressive. So when you look to trade a bounce, you can of course trade the short at that point, but if you're looking for the bounce where it hits supports, and you've plotted a support previously along that line anyway, it needs to be a bit tidy, doesn't it? Let's get rid of that. So we have we can see it sort of hits supports and resistances, so it kind of does follow through. Try and make that a bit clearer. So we have that point there, which is a very clear support, and we get an aggressive movement upwards from that. You can, of course, maybe even put the support a little bit higher up, where it's met a couple of more candles, but you get the idea, where we have this very strong move down and then a very strong bullish move up. And you can usually tell if it's a very aggressive movement down, and you can apply some indicators to this of course, then the closer it gets to a very strong confirmed support, the more likelihood that you're likely to see an aggressive bounce. Certainly if you've seen it do that before, much like we've seen in this point here, we've also have them. Very strong bullish move down, hits the support, aggressive move up, and that's the bounce there. Now a retracement is very similar, but it's the reverse of that. So we have a support just generated here, 2 points there, we've got an aggressive move up, and a retracement, a good retracement, is always followed by an equally aggressive move upwards. It'll hit the resistance being generated here, and as soon as it hits that resistance, we'll get a thinning market, much like we were discussing with the candles. So we'll get a relatively thin market and some bearish candles, and possibly some consolidation as well, as what we have here at the top. But usually within a couple of days we have a massive reaction. Sometimes it's less than a day. Certainly if you get what we were saying in one of the in the candlestick video, where we have a hammer, where it's showing the candlestick in shape of a hammer, which is hammering out the trend. If you get one of those, then you can expect the market to move dramatically quickly, and then you get a retracement from resistance. And that's basically it. You can use the Fibonacci tool, applying it to the chart to see where your rewards are likely to be, and therefore gauge your risk reward on that. But if you understand where the bounces and retraces are going to be, and they will always be at the strongest points of support and resistance. Remember, a bounce is always a trade hitting a support. A retracement is a point where it's hitting a resistance and falling from that. You can then use that with the Fibonacci tool and put it between the two supports and resistances and gauge where you're likely to see your rewards overall, either as a bounce or a retrace. You can also combine any of the indicators that we've used as well. But I've obviously been trading for a number of years, and I tend not to use indicators so much, and predominantly use sort of my eye and supports and resistances. But I would, you can use the indicators that we've covered, and you can use other indicators. But once again, don't use too many indicators, one or two at the very tops. Use the Fibonacci tool to sort of gauge where supports and resistances are likely to be, or where your reward on a retracement is likely to be too. But the basic premise of a bounce and retrace is, a bounce is where it hits a very strong support and from a very aggressive movement downwards, and it bounces up aggressively like we have here and here. A retracement is the reverse of that, where we have a very strong resistance and we've got an aggressive move upwards, and it hits that resistance and it moves aggressively back down again. And that is a bounce and retracement. And you'll find as a trader, in whatever security that you'll trade, that predominantly most of your money is made from trading these movements. It's also sometimes referred to as swing trading, but some swing traders look to go a lot to the sort of the minuscule movements as well. And one thing I would really recommend you steer clear away from, if I were you, is try not to sort of trade sort of the very small moves, because if you're certainly trading spread betting, then the spreads themselves would eat up any profit, and there's a much greater risk there as well. So you're looking to sort of predominantly benefit from a very aggressive, strong moves from very strong supports and resistances. So those are bounces and retracements.